Welcome. I have done my best to break down velocity banking in the simplest terms possible with respect to a mortgage. Using a line of credit and a mortgage, I'm going to show you how it works and how powerful it is. Now, I'm going to put up here a previous video that I did that I think you should watch first. And in that video, I called it the secret mortgage hack. And that explains how the interest works. And it's quick, it's straightforward. I would watch that one first, then come back, or just continue watching. This one, we're adding velocity. All right, so I'm going to break this down. There's a lot on this board, but first we're just going to focus on this part. And then we're going to explain this part in your actual savings. So I'm Brian. I do mainly videos on how to save money, how to get out of debt, then how to use credit cards to your advantage, and then how to save money to create passive income, because I truly believe that real freedom is financial freedom. So I'd appreciate it if you smash the like button and leave comments. Is this helpful? Is it not helpful? What can I do differently? And if you see anything, errors you might think I've made, anything, I really appreciate you interacting. It helps the channel out. It helps push the video out itself. Okay, here's what I did. I just took what is the median price across the U.S. of a home. It was $420,000. I'm going to assume, I'm using round numbers here to make this simplistic. I'm going to assume that you're putting $20,000 down, so we end up with a nice round $400,000 mortgage. It's roughly 5%. I'm just looking at this from the standpoint of principal and interest, not getting into PMI or anything like that. Doesn't really matter, it's just going to change the numbers a little bit, but this keeps it simple. Okay. In this example, you've got your $420,000 home, you end up with a $400,000 mortgage. Your payment is $2,661 a month. Okay, so just look at this. By the end of the mortgage, you will have paid payments, 360 months, times this payment, you'll have paid a total of $958,000. The interest portion is $558,000. As you can see, the interest portion of the total is large, and that's why this method works, because velocity banking attacks the interest. I'll explain. Now, in total, what did you pay? If you watch that other video I was recommending, you'll see how I did this. You put $20,000 down. You made payments totaling $958, so you add that. $958 plus 20 is $978. So in total, at the end of 30 years, you will have given the bank $978,000. Okay. Now, in this example, same thing, $420,000 home. You put a $20,000 down payment, you have a $400,000 loan. You walk out, you've got your loan in hand, you're all happy, and within a day or two, you make a $20,000 payment. Now, we'll get to how you do that in a moment. What does that do? It immediately drops your balance to $380,000. Now, over the length of 360 months, you will have paid $819,454. Interest would be $439,000. Your payment's the same. So as you can see, the total is going down substantially. Now, what is the real total? The real total is this, all of your payments, plus the 20 down, plus the 20 huge payment. So that's the 819 plus 40, so it's 859. So this method of throwing another 20,000 at it will save you $118,000 over the length of the loan. Two things you're probably wondering, where the heck does the 20,000 come from? But hold that one for a moment. The first thing is, why does this work? Well, if you're familiar with what they call an amortization table, it breaks down every single payment you make. And it says out of the $2,661, how much pays down your loan versus how much is interest and it's just gone and it doesn't affect you or help you in any way. When you first start out, of this 2,661, 2,333, almost the whole payment goes to interest that first month. Principal is only $328, meaning you're only paying it down by $328. The reason is the interest is calculated on the total that you owe, and you're starting by owing $400. Okay? In this case, because you made an immediate payment of $20, you drop the balance to $380, and interest is being calculated on $380,000, not $400. So the amount to interest is lower, the amount to principal is more. How much more over time? Well, the tune of $118,000. Okay, so now you get it. If you can drop the balance really fast, you're going to be able to save a substantial amount of interest because the majority of your payment is interest when you first start out. As the months go by, less goes to interest and more goes to principal. All right, now we understand that velocity banking is dropping your balance as quickly as possible by a large amount, thereby decreasing the interest and applying more to principal, and that's what you save. That's a lot of money. Okay, now the important part, where did that $20,000 come from? Okay, in this case, the idea is that you get a line of credit for 14%. A line of credit allows you to take out a certain amount of money, any amount you want, use it, replenish it, making payments back as much as you want. Now you'll probably have a minimum payment, but as much as you want, and then you can take out and use it, or you can pay it back in. Okay. You get a $20,000 line of credit, and that's what you use to make that initial payment. Great. Now you owe $20,000. All right. This is what you do. This represents right here 1 month. And you're going to do this every month. Now, what most people don't explain is that in order for this to work properly, you have to make more money than you spend. So, in this example, I'm using $12,000 in income. Let's say it's 2 people, or maybe it's 1. And $10,000 in expenses. So $12,000 is coming in after taxes and whatnot, and $10,000 is going out the door in expenses. Now, it doesn't matter that this is 12 and 10. You might be saying that's ridiculous. No one has that, but you'd be surprised. But what matters is that it could be 6 and 4 or 6 and 5, or as long as income is more than expenses, this works. So just follow the math. So the first thing you do on your $20,000 loan at 14% is you immediately put your income in there. So when you get the money comes in, you throw it in there. Granted, payroll may be twice a month, so you might do it in the middle of the month and the beginning of the month. But for making this easy, you put your $12,000 payment. So if you were to put $12,000 in here, you would immediately drop it, $20,000 minus 12, to $8,000. Okay, but of course you have expenses. So you use your line of credit. Usually you get like a credit card, and you just use it to make your payments. $10,000 in expenses. You add another $10,000 to your line of credit. Well, there's a difference of $2,000 here. So as you can see, you made a payment of 12, you ran up and added another 10, you're at 18. You dropped it from 20 to 18. Okay. Now, what a lot of times they don't explain is that of course there's interest. But the interest is calculated, just like over here, on the balance, or the average balance for the month. So you started at 8, you ended up at 18. All right, fine. Let's just say it's a $10,000 difference. Let's just say that during the month, the average is $5,000. Split 10, that's 5. 8 plus 5 is 13. Don't worry about all that. But essentially, I'm saying if your average balance was $13,000 during that month, and you were at 14%, your interest is going to be about $152. Okay. The point is, you made a payment of income, you spent your expenses, you had to pay interest at the end of month 1, you're at $18,152. Your $20,000 has gone down. You do that month after month after month. That's velocity banking. Throw your income in, use it for your expenses, drop it as fast as you can. Okay, at $2,000 a month, it would take you 10 months, and you would pay roughly over that period of time, $150 a month in interest times 10 months is $1,500. Let's be a little more realistic. And let's just say that you're only able to pay this down by $1,000 a month. So here's the example we're going to use. You pay it down by $1,000 a month, it's going to take you roughly 20 months. And you're going to pay about $3,000 in interest. So apples to apples, what are you actually saving? You're not saving the total 118 because this 20 is a line of credit with interest that you have to pay down. So how do we calculate what we actually saved? Well, we just showed that it's going to cost you $3,000 in interest. So the savings here is $118,582. But that extra $20,000 cost us $3,000 in interest. So we take the $118,582 and we subtract $3,000 from the interest. We also had to pay back the loan of $20,000. So we subtract $20,000. $95,582. So using this method, with the line of credit, with an interest rate, you're dropping the principal down very quickly. which decreases the interest, and the interest savings over here is much larger than the interest cost over here. That's why it works. Even though this is a 7% mortgage and this is a 14% line of credit, you might think, well, that doesn't make sense. Well, it does, because we're talking about $20,000 as opposed to $380,000. Okay, so where does the real power come in? We just saved $95,000. That's awesome. Now, the real power of velocity banking is you do it again and again and again. So at the end, in this case, at the end of 20 months, you've paid this off, and you now owe $0 in your line of credit. Here we go. Do it again. Take the $20,000 of your line of credit, throw it at your mortgage, decrease the balance, make a $20,000 principal payment. What does that do for us? Well, here you go. If you were to do it a second time, you would save a total of $194,271 in interest. But what did it cost us? We did this twice. So we paid $3,000 in interest twice. So we're going to subtract $3,000 once, subtract $3,000 again. We also paid this sucker back twice. So we're going to subtract $20,000, subtract $20,000. At the end of the day, we saved $148,271. Also, if you did it once, you would have knocked 4.5 years off your mortgage. In this case, by doing it a second time, you knock 7.5 years off. So you'll be done in 22.5 years. You took a 30-year mortgage, you paid it off in 22.5 years, and you saved $150,000. I didn't do the math again, but as you can see, that's just 40 months, right? 20 months, did it again, 20 months, that's just 40 months, which isn't even 4 years. So you do it again and again and again, and you drop this incredibly fast, and you save an unbelievable amount of money. I hope I was able to describe this in a manner that makes sense. I greatly suggest you watch the other video first, and then you watch this one, so that you can understand how the interest works, and how, with this video, how you apply the line of credit. I used nice round numbers. If you have any questions, please leave them in the comments below. I really appreciate it if you smash that like button. It'll get the video out to more people, helps the channel. I really want to get people out of debt, especially high rate credit cards and things like that, and people saving for their future, because like I say all the time, real freedom is financial freedom. Thank you for watching, and I hope this was short, succinct, and to the point. Have a great day.